This isn't just another week on Wall Street. Oh no, this is a week of reckoning. It's the moment the lights finally come on for a market that has been operating in the dark for way too long.
And this quote from a New York strategist just hits the nail on the head. After weeks of flying completely blind, a flood of data is coming our way, but nobody is quite sure what it's going to reveal. You can almost feel the uncertainty in the air.
So why has the market been flying blind? Well, a record 43-day government shutdown created this massive data drought. It deprived investors and, maybe more importantly, the Federal Reserve of the critical info they need to make smart decisions. This week, that drought doesn't just end, it breaks with an absolute flood of new data. Okay, so first let's really get into the market's mindset here. How is everyone feeling as we're navigating this fog of uncertainty right before the data storm really hits?
Right now, it's really a tale of two competing feelings. On one hand, you've got this guarded optimism. There's a real hope for that economic soft landing, where the economy cools down just enough to beat inflation without crashing into a recession. But on the other hand, there's this deep, lingering caution. And it's all fueled by that lack of data and the giant question mark hanging over the Fed's next move. So where's all this optimism coming from? Well, believe it or not, a surprisingly strong third-quarter earnings season. I mean, look at this. Over 80% of S&P 500 companies actually beat their forecasts. That provided a much-needed confidence boost against all this uncertainty.
Okay, so all of this sets the stage for some major showdowns this week. We're going to look at 4 key sectors where the market's battles will be fought. Think of them as individual storylines to watch. First up, the tech sector. It's been the market's locomotive, right? Powered by this massive enthusiasm for AI. And that makes Nvidia's earnings report on Wednesday, well, it's nothing short of a referendum on the entire AI bull trade. A good report could reignite the whole rally, but a miss? That could send shockwaves through the market. And we're already seeing some cautious investors hedging their bets, moving money out of those high-flying tech stocks and into safer spots, like healthcare. Then you've got energy, and man, it's on a total seesaw. On one side, you have an OPEC report hinting at a future supply glut, and that's been pushing prices down. But then on the other side, new U.S. sanctions are about to tighten the screws on Russian oil exports, which could create a floor under prices and stop them from collapsing. It is a classic push and pull situation. And of course, we can't forget the financial sector. Everyone is still processing the Federal Reserve's recent pivot. Back in late October, the Fed delivered its first interest rate cut of the year, a quarter-point reduction, and that signaled a huge shift in their strategy. But here's the thing. That rate cut from the Fed, it brings up this huge, looming question that hangs over everything else. With the cost of living up and interest rates shifting, is the American consumer, the very engine of our economy, finally starting to crack?
Well, this is the week we might just get our answer. It's a full-on retail reality check with earnings from giants like Home Depot, Target, and Walmart. These reports are so critical because they give us a direct, unfiltered look at consumer spending right before the make-or-break holiday shopping season kicks off.
All right, let's get to the main event, shall we? The data deluge itself. Let's walk through this flood of economic reports that's going to define the week. So, here's your roadmap for the week ahead. And just look at this thing. It is absolutely packed from start to finish with market-moving events. We've got manufacturing and housing data, and then, of course, that big delayed jobs report on Friday. It's going to be a busy one. But if there's one day you circle on your calendar, it's got to be Wednesday. It's a real triple threat. First, we get housing starts, which is a huge signal of how confident people are about making big purchases. Then, we get the Fed minutes, which will give us a peek inside the room when they decided on that October rate cut. And finally, as we talked about, Nvidia's earnings could sway the entire tech sector. And we absolutely cannot forget Friday. That's when we finally get the jobs report from September that got delayed. Now, I know what you're thinking. September? That's old news, right? Well, not so fast. It's crucial because it fills a massive gap in information for the Fed. It could still totally change the outlook on their policy. Okay, so we've got all these sector battles, all these data points flying around. What does it all mean? Let's try to put the pieces of this puzzle together and see what this means for you and for the market. In this chart right here, it tells a really big story. It shows one of the biggest shifts we've seen in market sentiment. Just a little while ago, a December rate cut was basically seen as a done deal, with odds over 50%. Now, look at that. They've tumbled down to between 40 and 45%. The market is just not convinced another cut is coming this year. And a huge reason for that change in thinking, it's coming straight from the Fed. Officials have been using this very cautious language, phrases like proceed slowly. That's a clear signal they are in no rush to cut rates again and risk sparking up inflation. The market has definitely heard that message loud and clear. So really, it all boils down to this. By the time we get to Friday afternoon, we should have a much better handle on these four fundamental questions. Is the economy faltering? How strong is the consumer, really? Is that whole soft landing idea still in play? And what is the Fed going to do next? Which leaves us with the one final massive question. After this absolute fire hose of information, after the lights are finally turned back on, will the market find the clear direction it's been so desperate for? Or are we just going to be left with even more questions than when we started?